Welcome to the June 2025 Evergreen Asset Allocation Committee meeting. Without further ado, let's start the meeting with an economic update by MAV, Global Economic Conditions and Geopolitical Developments. The global economic landscape has been characterized by significant geopolitical tensions over the preceding 6 weeks, with MAV noting that markets have demonstrated resilience despite volatility in oil prices and currency fluctuations, particularly affecting the Australian dollar amongst major currencies. NATO has announced a substantial increase in defence spending from an average of 2% to 5% of GDP, with 3.5% allocated specifically to military hardware, including tanks and missiles, whilst the remainder addresses cybersecurity and related infrastructure. This development represents a fundamental shift in European fiscal priorities and has contributed to outperformance in European defence and heavy industry sectors. The bond market response to the Middle East conflict between Israel and Iran demonstrated unusual behaviour as yields failed to decline significantly despite traditional safe haven demand expectations. Bond market investors remained focused on inflationary implications rather than seeking refuge, with concerns about oil price trajectories potentially reaching $140 per barrel, comparable to pre-GFC levels. However, Iran's decision not to target critical oil infrastructure or launch attacks on US soil allowed market tensions to subside, subsequently refocusing attention on underlying economic fundamentals rather than geopolitical risk premiums. United States Economic Assessment and Federal Reserve Policy. US labor market conditions have shown clear signs of deterioration, with annual non-farm payroll growth declining from over 2 million jobs at year-end to 1.73 million jobs in the 12 months to May, down from approximately 2.6 million the previous year. MAV highlighted that unemployment has gradually increased to 4.2%, with initial jobless claims trending upward throughout the year, though remaining below the concerning threshold of 300,000 weekly claims. The labour market weakness is particularly pronounced amongst new college graduates and entry-level positions, partially attributed by Duchesne to rapid AI adoption across companies affecting junior white-collar employment prospects. The Federal Reserve has significantly revised its monetary policy outlook, with the median expectation for interest rate cuts reduced from 4 cuts anticipated in March to just 2 cuts, whilst 7 voting officials now expect no rate cuts during the current year. Chair Powell's recent testimony emphasised a patient approach to monetary policy, indicating no urgency to reduce rates given current economic conditions. Market positioning reflects greater optimism than Fed guidance, with futures markets pricing in cuts for September and December meetings, projecting approximately 4 rate cuts by July of the following year, creating a disconnect between official Fed communications and market expectations. Australian economic performance and monetary policy outlook. Australian economic conditions present a mixed picture, with nominal GDP growth remaining below 4% over the past 12 months, creating revenue growth challenges for domestically focused ASX-listed companies. MAV identified concerning margin pressure prospects given rising input costs combined with limited pricing power in the low-growth environment. The household savings rate has increased above 5%, trending upward from approximately 1.5% nearly 2 years prior, reflecting reduced consumer spending despite growth in disposable income from tax cuts and other measures. Recent inflation data encouraged rate cut expectations, with headline CPI declining from 2.4% to 2.1% in May, whilst the trimmed mean measure dropped from 2.8% to 2.4%. This represents the first instance in considerable time that the trimmed mean inflation sits below the RBA's target midpoint, leading to 92% market probability of a rate cut on the 8th of July. Market pricing suggests 3 rate cuts by December, which MAV considers more likely than equivalent US monetary easing. Australian unemployment remains around 4.1% on a trend basis, with employment growth of 28,000 per month and unemployment growth of 1,500 per month, indicating equilibrium conditions that may persist given strong population growth of 1.7%, requiring robust labour market performance for social cohesion. Market valuations and investment positioning. Australian equity markets appear significantly overvalued across multiple metrics, with the market trading above 19 times earnings and approaching 20 times, substantially above the long-term average of 15.4 times. MAV expressed scepticism regarding continued domestic equity investment, given yields of approximately 3.2% compared to historical levels above 4%. Partly attributing current performance to mandatory superannuation flows rather than fundamental value. The ASX 200 has tracked US market performance over 12 months, despite lacking equivalent structural growth drivers, suggesting Australian markets are increasingly driven by global rather than domestic considerations. MAV describes the as a case of follow the leader. European financial institutions have demonstrated remarkable outperformance, with European banks exceeding mega-cap technology stocks over a 3-year period whilst maintaining modest valuations at 7 to 9 times earnings compared to Australian banks trading at 30+ times earnings. Jones highlighted the market disconnect, citing Singapore's DBS Bank trading at 11.5 times earnings with growing profits versus Commonwealth Bank's 30 times multiple with stagnant earnings growth. The momentum factor has generated extraordinary returns, with the S&P Momentum Index advancing 16% year-to-date compared to 3% for equal weighted indices, reflecting passive investment dominance as passive funds have reportedly exceeded active management for the first time, contributing to multiple expansion rather than earnings growth driving returns. Water rights, investing, asset allocation. Insights. Australia's water scarcity and regulatory framework. Australia's water rights investment framework stems from the nation's fundamental water scarcity challenges as illustrated by Kim Morrison, Argyle Group CIO and Chairman, through a comparative analysis of river systems and rainfall variability. The Australian continent's limited permanent water resources support only 35 million people across vast geographical areas, with the Murray River system demonstrating extreme variability with a coefficient of variation of 79% compared to California's 27%. This stark contrast underpins Australia's adoption of a comprehensive cap-and-trade regulatory system across Queensland, New South Wales, Victoria, South Australia and Tasmania, whilst Western Australia and the Northern Territory have yet to implement similar frameworks. The regulatory structure encompasses approximately 39,000 gigalitres of water rights issued across different states, operating through both river systems and aquifers. Morrison explained that these reforms, dating back to the early 1990s, culminated in the Murray-Darling Basin Plan, establishing water rights as tradable property rights with inherent scarcity value. The system prevents the construction of additional dams or water infrastructure, creating finite supply constraints. Morrison noted that WA's Ord River system, despite containing 18 million megalitres of stored water, experiences minimal capital appreciation due to limited irrigable land relative to water availability, contrasting sharply with the Murray system, where storage capacity is constrained relative to demand from extensive farmland along the 1,000-kilometre river corridor. The cap-and-trade mechanism operates on sustainability principles, defining resource extent for both surface and groundwater systems whilst establishing extraction limits through water rights allocations. Morrison emphasised that this framework addresses long-term environmental sustainability concerns that emerged in the early 1990s when policymakers recognised potential over-extraction risks. The system's evolution reflects Australia's commitment to balancing agricultural productivity with environmental protection through market-based allocation mechanisms. Water entitlement, structure and market dynamics. Morrison outlined a sophisticated 3-tier entitlement system using dam storage analogies to explain reliability differentials. Municipal supply occupies the bottom 5% of dam capacity, remaining full even during drought conditions and rarely trading due to government ownership. High security entitlements represent approximately 20 to 25% of capacity, providing reliable annual allocations that underwrite permanent agricultural developments requiring consistent water access. These command capital values 3 to 4 times higher than general security entitlements, which comprise the top 70% of capacity and face complete allocation suspension during dry periods. The dual market structure operates through both entitlement transactions, permanent asset ownership, and annual water allocation trading. Morrison illustrated this distinction by comparing entitlement ownership to property purchase, whilst annual allocations resemble rental arrangements. Current water pricing demonstrates extreme volatility, with Morrison citing the contrast between June 2023 prices at $25 per megalitre versus current levels around $300 per megalitre, representing tenfold increases reflecting supply constraints over the past 12 months. Historical pricing data reveals significant drought period spikes, particularly during 2007 and 2019 drought events, when water prices reached extreme levels due to limited allocations and intense competition among users. Morrison explained that this pricing mechanism functions as designed, discouraging low-value crop cultivation during scarcity periods. Cotton and rice production typically ceases during droughts as farmers find water sales more profitable than crop cultivation, allowing permanent crop operators with higher returns to secure necessary water supplies through competitive bidding. The market accommodates diverse participation strategies, with Morrison citing Cobram Estates' approach of purchasing annual water requirements without owning entitlements, in contrast with Select Harvest's mixed strategy of owning 20,000 megalitres, whilst sourcing an additional 100,000 megalitres annually for their almond operations. This flexibility enables capital-efficient farming operations whilst supporting water rights investment strategies through leasing arrangements. Agricultural transition and return. Differential analysis. Morrison presented detailed analysis of water use economics across agricultural sectors, demonstrating significant return differentials that drive structural industry changes. Dairy pasture irrigation generates the lowest returns, prompting sector migration to higher rainfall regions like Tasmania and Gippsland, rather than competing for increasingly expensive irrigation water in northern Victoria. Annual crops show substantial variation, with cotton achieving twice the returns of rice per megalitre, leading to cotton's expansion into the Murrumbidgee and effective displacement of rice production. Permanent crops command premium returns, with elite table grape and citrus operations achieving margins exceeding $2,000 per megalitre annually. Morrison noted that current water costs of $300 per megalitre remain economically viable for these enterprises, enabling continued operation even during drought periods when water prices escalate significantly. This return differential creates natural market segmentation during water scarcity, with high-return permanent crops successfully outbidding lower-value alternatives. The almond industry exemplifies this transition, with Morrison detailing a 2016 development project involving Select Harvests requiring $60,000 per hectare in development capital plus $90,000 per hectare in water rights value. The total $150,000 per hectare investment transforms wheat-growing land worth $3,000 per hectare into high-return permanent cropping enterprises. Morrison's analysis demonstrates how water rights leasing at 5 to 6% of capital value enables these developments whilst allowing farming operations to target 15 to 20% returns on their operational capital, rather than tying up resources in water rights ownership. Current industry dynamics show wine grape vineyard conversions to almond production due to global oversupply and Chinese tariff impacts on Australian wine exports. Morrison indicated this represents ongoing structural adjustment rather than a one-time transition, with water progressively shifting toward higher value applications. The Victorian Murray system data shows a strong correlation between almond acreage expansion and water rights appreciation, demonstrating how agricultural transition drives asset value increases. Investment thesis and market outlook. Morrison's investment framework centres on increasing water scarcity driven by multiple factors, including permanent crop development, Murray-Darling Basin Plan implementation, and climate variability. Current Bureau of Meteorology forecasts suggest continued below-average rainfall prospects for southern states, with Pacific and Indian Ocean conditions directing winter rainfall systems further south than typical patterns. The approaching July water year commencement will determine 2025 to 26 summer supply availability, creating immediate market focus on allocation prospects. Demand analysis reveals potential supply-demand imbalances, with Morrison referencing the 2021 Ricardo analysis for Victorian government, showing extreme drought scenarios potentially creating insufficient water availability for mature permanent crop demand. This analysis, whilst dated, illustrates structural risk factors supporting long-term scarcity themes. Morrison acknowledged the forecast's 2021 vintage, indicating ongoing relevance despite temporal limitations. The Murray-Darling Basin Plan implementation creates additional supply constraints through environmental water buybacks, shifting the historical 70% environmental versus 30% irrigation allocation ratio further toward environmental flows. Morrison identified this taxpayer-funded buyback program as providing systematic tailwinds toward increased scarcity and asset value appreciation. Combined with the prohibition on new dam construction, these factors support the investment thesis around finite resource appreciation. Morrison's track record demonstrates outperformance relative to managed farmland investments through water rights focus, avoiding operational farming risks whilst targeting the most limiting agricultural input. The strategy encompasses geographic and entitlement type diversification across Australian systems, emphasising regions with scarcity characteristics rather than water-abundant areas like the Ord River system. Annual income generation through water sales and leasing arrangements provides current yield whilst maintaining long-term capital appreciation exposure through the underlying scarcity dynamics driving structural agricultural transition toward higher value water applications. L1. Capital Equity Market Update. Market valuations and momentum-driven dynamics. Mark Landau presented a cautionary outlook on current market conditions, emphasising that both Australian and US markets are trading at record highs despite significant global risks, including trade tensions, geopolitical conflicts, and slowing macroeconomic conditions. The Australian market has reached the same levels as mid-February prior to tariff concerns, whilst the US market has recovered strongly, essentially pricing in a zero-risk scenario. Landau characterised current valuations as pretty full and reflecting an unrealistic assumption of perfect outcomes. Market performance has been predominantly momentum-driven across both regions, with traditional value factors delivering negative returns in Australia, whilst momentum strategies have generated positive outcomes. In the US, momentum represents the singular successful factor for the calendar year. This environment has created challenges for fundamental investors with value orientations, though L1 Capital has maintained outperformance despite these headwinds. The artificial intelligence theme has dominated global markets, with companies receiving significant valuation premiums merely for AI-related commentary during conference calls, regardless of tangible business improvements or profitability enhancements. Australian defensive stocks are trading at historically extreme valuations, with Commonwealth Bank at approximately 31 times price-to-earnings ratio compared to its long-term average of 16 times, and Wesfarmers at 32 times. Macquarie Research characterised this as a 5 standard deviation event, theoretically occurring once every 12 million days. These valuations reflect substantial departures from fundamental metrics, driven primarily by non-fundamental factors that Landau expects will eventually normalise. Bond market risks and US fiscal challenges. A critical concern highlighted was the 30-year US Treasury yield approaching 5%, which directly impacts mortgage rates for American consumers. Unlike Australia's variable rate structure, US mortgages are predominantly fixed rate, meaning new home buyers face approximately 7% rates fixed for 30 years. This dynamic has created gridlock in the housing market, with significantly reduced turnover affecting broader economic activity and employment, given housing's substantial role in economic activity and wealth creation. The US federal debt situation presents mounting structural challenges, with annual interest expenses increasing from approximately $500 billion several years ago to $1.2 trillion currently. Particularly concerning is that 30% of all US federal debt requires refinancing within the next 12 months, creating substantial pressure on Treasury Secretary Scott Bessent to manage this rollover at manageable rates. This situation has led to Trump publicly discussing replacing Federal Reserve Chair Jay Powell to secure rate cuts, as the administration requires short-term rate reductions, whilst being unable to lock in long-term debt at current 4.9% yields. The refinancing challenge creates potential for yield curve steepening if markets perceive excessive dovishness at the short end, potentially generating inflationary pressures and concerns about US debt sustainability. These dynamics are reflected in alternative assets, including gold, cryptocurrency, and stablecoins, representing various hedges against US dollar debt sustainability concerns. Landau referenced analysis by Stan Druckenmiller indicating that interest expenses could become the largest federal budget component by approximately 2032 to 2035, contingent on prevailing bond yields during refinancing periods. Earnings, expectations, and regional market analysis. Forward-looking earnings analysis reveals concerning valuation metrics across major markets. With 12-month forward earnings, multiples significantly stretched versus historical norms. The Australian market trades at nearly 20 times earnings for both the ASX 200 and 300 indices, compared to long-term averages of 15 to 16 times. NASDAQ valuations have reached 30 times earnings, with both markets positioned at the upper extremes of normal trading bands. Landau expressed skepticism regarding consensus earnings, growth expectations of 7% for Australia, suggesting potential downside risks. Market concentration presents additional concerns, with the top 20 Australian stocks comprising approximately two-thirds of the total index, making it difficult to identify undervalued opportunities within large capitalisation names. Banks trade at elevated historical levels, insurers appear expensive, and Transurban offers dividend yields below risk-free rates. The construction of a compelling undervaluation argument for the Australian market appears challenging given these metrics. Consumer spending moderation has become evident since April, with Landau noting that retailers providing updates at the Macquarie conference deliberately excluded April figures, suggesting weakening conditions beyond Easter timing effects. Companies face challenges with top-line growth whilst managing increasing costs, including wages, electricity, and rents, creating margin pressure. Given that consumer spending represents 65% of GDP, this trend suggests broader economic deceleration, whilst Australia's productivity growth remains at historic lows, further constraining earnings growth potential for companies unable to rely solely on price increases in a softening environment. Investment positioning and sector opportunities. L1. Capital's investment approach emphasizes bottom-up stock selection with top-down risk management, avoiding concentration in macro themes whilst maintaining significantly lower US equity weightings compared to benchmark allocations. Their portfolio construction reflects valuations concerns, with average long positions trading at less than 10 times earnings, half the Australian market multiple and one-third of NASDAQ multiples, whilst generating approximately 15% earnings growth, double the Australian market rate. Infrastructure represents their largest sector exposure, targeting assets where markets focus on historical rate increases rather than anticipated rate cuts across major central banks. Examples include Fraport, trading at 13% free cash flow yields for regulated monopoly airport assets with 4-year cash flow certainty, and similar European infrastructure companies, including Cellnex and Getlink. Chorus, a long-standing position initially purchased at $1.60 approximately 10 years ago, currently trades near $8, whilst providing 7% dividend yields with continued growth prospects. Mining sector opportunities centre on gold and copper exposures, with gold stocks failing to reflect the paradigm shift in gold prices from $2,100 to $2,200 to current levels of $3,400. The significant gold price appreciation contrasts with modest 5% cost increases, creating substantial earnings inflection points not reflected in equity valuations. Copper investments provide indirect exposure to AI, data centers, electric vehicles, and sustainability trends, with supply constraints over 5 to 10-year horizons due to declining ore grades and production challenges. Additional positioning includes construction materials benefiting from infrastructure spending, UK quality value opportunities including Lloyd's at 6.5 times earnings with 20% growth and superior metrics to Commonwealth Bank, and energy positions including Santos and uranium exposure through NextGen Energy. With that, we can now move on to summarise all the discussions and frame a portfolio construction strategy. The committee engaged in extensive discussion regarding current market dynamics and structural shifts in global economics. MAV initiated analysis of the US dollar's evolving role, noting the Trump administration's apparent strategy to engineer a managed real depreciation of the greenback while maintaining its reserve currency status. The committee observed that this approach aims to enhance US international competitiveness through currency devaluation rather than manufacturing efficiency improvements. Particular attention was given to the sustainability of current currency movements, with the committee noting the Australian dollar's surprising resilience during recent risk-off periods, contrasting with historical patterns where it would have declined significantly. The committee discussed how Australia's trade linkages with China may be providing currency support, with MAV suggesting that purchasing power parity estimates had been revised upward by the IMF. The committee examined global manufacturing competitiveness, with members expressing skepticism about the effectiveness of currency-based solutions for US manufacturing revival. Kingsley highlighted China's superior supply chain management capabilities, noting their 30% share of global manufacturing compared to the US's historical peak of 50% in the 1950s. The committee concluded that integrated supply chains and manufacturing complexity, rather than currency values, would likely determine competitive outcomes. The committee also noted concerns about asymmetric market risks, agreeing with external presentations that markets appeared priced for perfection with limited upside potential. Members discussed the persistence of growth versus value dynamics and the challenges posed by potential tariff implementations, particularly noting complexities in supply chain restructuring that may not be easily arbitraged. The committee conducted a comprehensive review of the portfolio allocation, maintaining the strategic growth-defensive split while proposing targeted adjustments within the defensive allocation. Members expressed broad satisfaction with the growth assets positioning, particularly the international equity bias and non-US focus within global allocations. The committee focused primarily on defensive asset positioning, identifying opportunities to enhance the Australian duration exposure relative to global duration. Brad highlighted the potential for Australian duration to outperform given the divergent monetary policy paths, with the committee agreeing to increase Australian duration from 10% to 12%, while maintaining the global duration underweight position. This decision reflected concerns about limited Federal Reserve rate cuts in the US and the relative attractiveness of Australian yield curves. The committee approved a reallocation within the credit space, moving 1% from cash to Australian credit to take advantage of wider credit spreads observed over recent months. This change was viewed as improving the risk-return profile while maintaining a credit quality focus. The adjustment brought total Australian credit exposure above target levels. which the committee deemed appropriate given current market conditions.